Okay, well, good afternoon and welcome to the end of July Asia Credit Wrap. My name is Adam Etherington, so I head the sales commercial business here in Asia. It's been a little while since I've sat in this chair, been on the road, saw clients in Taiwan, Hong Kong, Australia, so it's been a good travel, but exciting to be back up here. We've got Zerlina leading our Asia strategy, Lakshmanan looking after our South and Southeast Asia credits, and first time in the seat, we've got Karen Wu from our Asian financials team. So a lot of good stuff and exciting stuff, but maybe we'll get right into it, starting with Zerlina. So our global strategy team put out our rest of year outlooks as well as a preliminary look into 2026. This is something that I've been talking to clients with a lot over the last 30 days, but would you mind kind of walking us through some of the highlights specific to Asia coming out of those reports and key takeaways?
Yeah, sure. First, I will go through our U.S. rates, macro, and yield view. So for the rest of year of 2025, we are maintaining our view that Fed is going to be on hold. The reason is two. The first is we think the core PCE will remain very sticky because of the pass-through from U.S. tariffs. We think the labor market will continue holding up because the falling labor participation rate is going to keep the unemployment rate artificially low. So our year-end 10-year U.S. Treasury yield forecast is still at 4.75%. But moving into 2026, we think the U.S. economy is going to decelerate significantly. We are expecting the labor market is going to soften. We are also seeing U.S. consumer spending is going to further decelerate. That is going to prompt the Fed to start cutting 25 basis points starting 2026 at every meeting, totally 100 basis points in the first half next year. And because of this, our view on the U.S. 10-year yield is more dovish. For June 2026, we're looking at 3.5%. This is much lower than the forward curve as well as consensus. Because of our 12 months U.S. Treasury yield view as more dovish, so we have a preference for duration risk over credit risk, especially given right now globally the credit spread has been very tight. We are also comfortable to extending duration out in a curve all the way to 30 years because the real yields there are still relatively high. And if U.S. recession risk or fear is back in the agenda, then this is going to come down. We are seeing the good entry point is for 10-year yields at 4.5% and 30-year yield at 5%. So we are slightly below these levels now. For the rest of the year, we still suggest investors to stay nimble. When it comes to the U.S. IG and high yield spread, we are forecasting the year-end IG spread at 110 basis points and high yield at 350. And for June next year, IG at 130 and high yield at 450. So this is quite significantly higher than the current levels. The reasons being we think U.S. credit fundamentals is going to deteriorate. We think the economy is going to slow down, and a lot of the technical supporting factors, such as the funding flow into the U.S. assets, might decelerate. Now moving to the Asia credit, I think year to date or last year, Asia credit continued to outperform the other peers like US IG, Euro IG, and also in the high yield space. This is largely because of our macro backdrop is very benign. There is a continued negative net new supply, as well as the credit fundamental is still really solid. Now moving into the second half of the year, we think the spread is probably going to still range bound because the negative new supply factor is still there. Year to date, we are seeing the new shoes slightly faster than our expectation, but negative new supply is still at 5 billion, this range. Second half of the year, we're looking at a negative new supply of 15 billion because a lot of the new shoes was front loaded in the first half of the year. And when we are looking at the spread moving into 2026, we also see the risk of Asia spreads to go wider for two reasons. The first, if U.S. there is a recession risk of U.S. credit fundamentals deteriorate, then the risk sentiment is going to come down, and this is going to affect the Asia spread. And the second reason is because our thought is the U.S. core yields are coming down, and in Asia, a lot of the buying is driven by all-in yields. When core yields coming down, and all-in yields in Asia will come down, and that will suppress some of the demand from all-in yield buyers. I guess in terms of the strategy, even though spread might go wider, we still recommend investors to stay invested because the carry is still good in Asia IG credits, as well as some of the high yield segment. We like a barbell strategy in terms of credit risk, so have position in defensive credits as well as of some of our selected beta credits. So we think the credit selection is really key here. And please do pay attention to our monthly Asia Credit Best recommendations. And the other thing is about portfolio protection. We think diversification across different markets and currencies will really provide the best protection for your Asia IG and high yield portfolios.
There's a lot there, and I think your point on spreads remaining tight, supply deficit can be a bit of a challenge. The thing we've heard from everyone on the street is there's still a lot of cash to put to work. There's just not much paper out there, so keeping an eye out for that. Other topical news, and I was on my way in and saw Bloomberg headlines on South Korea and India. So U.S. tariff policies were 1 day away. These things are front and center. And the market's looking at these headlines, they're looking at the spreads, they're looking at historical tights, trying to factor in, what is this new global trade going to look like? What's it going to do? Love to hear you guys, and I kind of go across the panel here for impacts on U.S. tariffs to the trade. So maybe we can kind of go around, starting on maybe Big Beautiful Act with Korean EV and batteries to start with, and then move on from there.
Yeah, right now the tariff is still front and center for a lot of Asia credit investors. It's not just about the number, how much is the tariff rate, but also about a lot of U.S. policy changes, especially things like the One Big Beautiful Act. I think for the Korean EV battery sectors, the changes related to the Inflation Reduction Act is largely in line with our expectations. So the EV subsidy under the Clean Vehicle Act has been abolished, so no more subsidies starting from September. This is definitely going to negatively impact the EV adoption rate and EV demand in the North American market. However, we do see some mitigating factors, such as the US OEMs are rolling out some of the affordable new EV models. And in the European market, I think it's still going to be a big drag on a lot of the EV makers. US is still relatively better. Another thing to note is the manufacturing related tax credit. This one still stays. Even the timeline for the phase-out period still stays as the original Biden Act. So for this, we think the Korean EV battery makers are going to continue benefit from this. For instance, names like LG Energy Solutions, 1/3 of its EBITDA is coming from the AMPC tax credit. And other than that, there's one thing is increased scrutiny on the component sourcing from foreign entities of concerns. This means a lot of the Chinese battery makers, their entrance into the US market and North American market will be more difficult. And this provides additional protection in terms of the market share for the Korean battery makers. I guess if we quickly look through some of the Korean corporate earnings, say for LG Energy Solutions, the result is still quite good. I think it's better than feared. EBITDA margin was better than expectation. North American shipment and Asia shipment is still good, even though there is some weakness in Europe. And some of the ESS battery-related demand is affected by tariff, but not so much. Looking forward, we still think this credit is going to have a pretty good medium to long-term credit outlook, and we still like the 2030 and 2035 for spread pickup. To note, we have an outperform recommendation on this name, and it has been one of the stellar performer this month. Other than that, a few other names to mention is SK Hynix. Results is still good, outlook is good, but we think it is largely priced in. There is a lot of tariff-related pull-in demand in the first half, but the company expect AI-related demand as well as the PC replacement cycle for conventional demand to remain robust in second half of year. But there are some questionings about the 2026 demand because the competitors like Samsung and Micron, they are quickly ramping up production. Then LG Electronics, very weak because of the consumer demand impacted by tariff. But I guess for a lot of the corporates, the tariff is really about the secondary impact.
Okay. Just flipping over here and looking at Mongolia, the 50% tariff there, especially on copper. We just launched on Mongolia as well. Some of the key banks there, maybe Zerlina and Karen, can you guys tackle thoughts on that impact?
Yeah, so I'll quickly talk about the copper one. So for Mongolia, we're not seeing a very big impact. Maybe first some background on the copper tax. So the U.S. Announced this 50% tariff on the copper imports to the U.S. The market was expecting about a 50%, so the 25%. So this is doubling the market expectation. For Mongolia, we see very limited impact because first, U.S. is not a very important exporting destination for Mongolia. The largest exporting destination for Mongolia is China, and we expect the copper demand to continue to be very strong because of the structural deficit of this metal in China. And in the ex-US market, we think the copper demand is very price inelastic. And globally, there's also a structural shortage of this metal. We still have an outperform recommendation on the sovereign because we think economic growth is going to be sustainable, and also the fiscal discipline as well as external position has improved.
Yeah, maybe I just follow this on our recent initiation on Golden Bank, which is a top 3 bank in Mongolia. This is actually a very different credit story from other APAC banks that we currently cover. Because firstly, Mongolia is a small open economy with a heavy reliance on commodity exports. And secondly, the Mongolia banking regulation is still in the early stage of development. And we see the Mongolia domestic interbank and capital markets are still underdeveloped. So this has resulted in the Golden Bank's $400 million bond have a significant 10% share in its funding structure. And there is limited alternatives for refinancing except for issuing another dollar bond. But on the other hand, Golden Bank actually its operation is much like other typical commercial banks. So it has a quite balanced loan portfolio, which comprise 55% corporate loans and 45% retail loans. And it also has a solid deposit base, which accounts for over 60% of its total funding. So it's actually a very typical commercial bank and is one of the 5 DC banks in Mongolia. But we see major risk rising from its asset quality and its loan growth, which is highly related to the country's cyclical economy. But in the near term, we expect its asset quality and profitability to both benefit from the country's positive macroeconomic conditions. So we see potential for the current trading levels of its dollar bonds to tighten around 100 basis points from the current levels. So that is why we have an outperform recommendation on its name. Maybe I just follow here to cover the earnings results for these countries that have this tariff impact. So the first one is about Thai banks and Indian banks, because we often compare these two countries' banks against each other. So we see some similar trends from Thai bank and Indian banks' earnings. So both markets, they are under margin pressure because their central banks are reducing policy banks, and their loan growth are both struggling because of the tariff impact. And as a result, their net interest income is broadly lower. But on the other hand, lower market rates also boost their non-interest income. But we also see some difference. So if we take a closer look, the Thai banks, they are still struggling with the fee income growth, and their credit costs remain elevated. But on the other hand, Indian banks, their asset quality has held up steady, and their fee income, we also see a broad rise. So overall, the Thai banks, we see they face more headwinds from the economic conditions and asset quality, while Indian banks are in a relatively better position. So that is why we would expect Indian banks to trade at least flat to the Thai banks, but we currently still see them 5 to 10 basis points wider. So, and we see this more because of the tighter levels of Thai banks. So that is why we have underperform recommendations for Thai banks and market perform recommendations for Indian banks. And moving on to South Korea. So at least 15% tariff is actually not a surprise and within expectation. And we see Korean banks are in a better position than in Q1. This is primarily thanks to the improved domestic political stability. So this not only boosted the domestic consumer sentiment, but also triggered a strong rebound in the stock market and raised more hope for more additional policy supports for the SMEs and low-income families. So these are all good signals, and we do see a strong Q2 results from the big 4 Korean banks, and this helped to offset a weaker Q1 and led to some modest profit growth in the first half 2025. And looking ahead into the second half year, although the net interest margin pressure will sustain due to the potential central bank policy rate cuts, we expect the margin contraction to be controlled within a few basis points, and we expect the non-interest income growth to sustain because of a low base in the last quarter 2024, which was hit by strong FX volatility, and credit costs should normalize from here. So overall, we see the situation for Korean banks as quite positive in the second half year, and we maintain our market performance recommendations as their trading levels are already quite high and fair compared to the other APAC peers.
I'll just add here on since we are on the tariff topic.
Yeah, please do.
We have seen that Trump has imposed a 19% tariff on both Philippines and Indonesia. So before looking at what could be the impact for the corporates which are under our coverage and even some of them which are outside of our coverage, we see that for Indonesia, we see some impact on certain credits. For Pertamina, as part of their pledge to import close to 15 billion worth of energy from the US, we see that their margins could be hit because of their higher cost of procurement, because the logistical cost of sourcing the energy all the way from the US as compared to from their current sources, which is from Middle East or other Asian currencies, could be much higher. So we see the margins for Pertamina to shrink. For Jaffa, the effect could be a bit more mixed. Indonesia has pledged to source about 5 billion of agricultural products, because of which the cost of corn and soybean will be much lower, and that should aid Jaffa's input cost. But on the other hand, we think that the supply of poultry from the US could increase, and that will lead to much lower revenues as well as average selling prices. In terms of Indofood, that could be another beneficiary, given that as the agricultural imports from the US could turn out to be cheaper, and therefore for the noodle maker, their input cost base could decrease. For the other names that are in Indonesia, they have very little exports into the US, and therefore we see very limited in general for the other Indonesian corporates which are under our coverage. For Philippines, the impact is much more limited, and that's mainly because they have exports that account for much less than about 5% of their total revenue base. And therefore, even as an economy and as a macro for Philippines, their contribution of exports to their total GDP that goes to the US is also quite manageable. And therefore, we see very limited impact on the Philippine corporates across the board. Finally, we have seen that for India, Trump has unilaterally threatened a 25% tariff. They have not really reached an agreement on that. They have just one more day before they hit the August 1st deadline. But if US were to go ahead and impose a 25% tariff, then it would be much higher than what in fact, the investors and even us expected that India would face in the terms of US tariffs. And generally, it would be negative. Having said that, when we looked at our coverage space and their exposure to the US, only a few names like Biocon, Tata Motors, the steel companies had exposure either directly or indirectly to US exports, and therefore the impact would be limited to these names within the US dollar credit coverage. For the other names, the impact or even the risk are quite manageable. Yeah.
Okay, good to hear, and that's more headline news than anything.
Yeah.
Zerlina, flipping back to you, we hear a lot of talk on dollar as a risk asset and de-dollarification. Not a lot of action around that, but a lot of talk on it. But that said, in Asia, there's always been a bit of a rates game, and with the dollar strengthening against Asian currencies the past month, we're still seeing strong interest in those local currency bonds. I know we put out a piece just on our picks for Australian dollar bonds just about 2 weeks ago. But what are other observations and thoughts and trade ideas you're seeing in Asian currency?
Yeah, sure. I think the bigger background for investors to chase this segment is because first on the FX front, Asian FX massively outperformed the dollar against the broad dollar weakness year to date. And Asia duration also outperformed the US duration because the Asian central banks are very proactively cutting the rates, aside from BOJ, of course. And if we look at the selected market, for instance, Australian dollar, this is one market we like for a couple of reasons. The first reason is there's a very good spread pickup on the OAS basis on the index level. It's about 30 basis points versus the US Asia ex Japan credits. And if we look at the yield, it is about comparable to US bond yield, but the rating of Australian dollar bonds on the index level is higher and also is quite diversified across different markets and different capital instruments. When we did our screening, we are looking at the bonds with after cross-currency swap of more than 5%, looking at the new issues in 2026 and 2024. And we are also screening for slightly higher spread levels. And of that, we picked a few Australian bank seniors. There are also a few corporates. You can refer to our notes for the full list of new issue picks in 2024 and 2025. Another area I want to highlight is in the CNH space. So recently, we are seeing quite booming issuance from the CNH bond, and it has become very topical with investors because there's increased inflow into the CNH market from mainland China. If we look at the performance year to date, the total performance is very good, but that's mainly because of the China rates movement, because the China rates, especially CNH rates, it rallied about 60 to 100 basis points across the curve year to date. And reasons is because of the liquidity of CNH is improved because of capital inflows, also because of the currency management. With the dollar as weakening, the PBOC is keeping a looser grip on the CNH liquidity at the front end. But if we look at the relative value, CNH bonds are actually not very attractive. The all-in yield of CNH bonds after cross-currency swap is about 30 to 60 basis points lower than their comparable dollar bonds. But there are some reasons for holding on to this. Some of the investors, they do like to diversify into CNH, and the new issue is picking up in CNH because of the funding cost is particularly lower, and especially for Chinese corporates, it's a very attractive place for them to issue their bonds for refinancing. So for investors looking to deploy in the segment, we also set some selection criteria. This includes the post-currency swap is more than, the yield is more than 4.5%, more than 1 billion of CNH amount outstanding, and also we look at the issuers with at least a market perform and outperform recommendations. Our picks are skewed towards the long end and ultra long end, which is 10-year and even 30-year, because the market dynamic is some of the new issues from high quality issuers like Hong Kong Airport Authority, MTRC, and Swire and Temasek. These ones, when they issue a longer dated CNH bond, they tend to have a pretty good pricing level for the 30-year tranche, and that's why our picks are slightly skewed towards the long end. This is good for investors who are looking to add some duration in the local currency space.
So kind of hanging around China for a little bit with the CNH piece. They had the Politburo yesterday, and Chinese equities haven't done much today, so not a lot of reaction on the market side. Any key takeaways from that? Are we looking at stimulus in the second half of this year? Property market going to rebound finally? What's the key takeaways you're seeing from that meeting yesterday?
Yeah, I guess the key takeaway is there is nothing new coming out from that Politburo. I think the market hope was still very high heading to the Politburo, especially in terms of property support and maybe a broad-based fiscal stimulus measures, but we were expecting not so much. The reasons is because if we look at the first half of the year, Chinese economy was actually going quite strong from industrial production, exports or consumption. Everything was going quite okay. So in the statement coming out from the Politburo meeting, the policymakers are turning more optimistic towards the second half of the economic growth. And because of that, they refrain from mentioning broad-based fiscal or monetary stimulus. And looking into the second half of the year, we expect monetary easing to be more backloaded in the fourth quarter, including 10 basis point of policy rate cut. And moving into next year, when US slows down and when the base of comparison is higher, we we expect another 10 basis point of policy rate cut. Another interesting thing to flag out is at the Politburo meeting, there is a quite clear shift from stimulus measure towards reducing excess capacity in selected industries like solar, EV, hog farming, and cement, steel, some of the traditional heavy industries. And this idea was floated already, I think in June and as early as last year, and in April this was flagged. And this news headlines boosted the China-sensitive commodity as well as Chinese equities, because when you reduce capacity, it's supposed to boost the margin as good for some of the industrial companies. In our view, is this the difficulty for carrying a very large-scaled supply-side reform is very difficult in the second half of the year, given there are still a lot of external uncertainties. The Chinese domestic economy is still very fragile, and for some of the sectors they mentioned, such as EV, high tech, or even e-commerce, food delivery, this is still the targeted supporting sector for China. So we don't expect a very large scale of supply side reform. When it comes to how it matters to the market, I think one thing to note, especially for investors invested in CNH, in the past couple of days, there has been a sell-off in China rates. And one reason is because of this hope for stimulus made some rotation from bond to the equity market, and there's a bond redemption and China rates sold off. Looking into the second half, looking into the next 6 months, we don't think the sell-off is going to persist given the still very weak domestic demand. And we think by nature, monetary easing will come through in the fourth quarter, and that will put a cap on the China rates.
Okay. Kind of leaning over to Karen, there's some market chatter on the China AMCs being asked to potentially do some heavy lifting again. Any commentary, or what are you hearing, and what should our clients be thinking about for that space?
For Chinese AMCs, we actually published quite a few pieces about their recent developments about regulation and business. And the most recent piece we focus on an interesting trend we've noticed, which is that we see they are actually trying to boost their financial results through investments in Chinese bank stocks. So in some cases, they purchase and convert CBs issued by some weakly capitalized joint stock banks, and this can simultaneously boost these banks' capital and boost the AMC's financial results. Like, for example, the CITIC AMC's purchase of Everbright Bank's CB, and more recently, Sinda's purchase of SPDB CBs. And in other cases, they buy these bank stocks directly from the open markets. Like the most recent one is the Great Wall's purchase of Mingshen stocks. And earlier, there is Citibank also purchased BOC stocks. And we think that these investments in Chinese banks they are actually quite efficient ways for AMCs to improve their profitability in a short term, in a very short time, and can also enhance their capital. But actually, this is achieved somehow through leveraging some accounting rules, and we explained in detail how this was managed in our note. You can refer to if you're interested. But anyway, this will not change our view for the sector. So we continue to expect their core business, only distressed debt business, to remain very weak in at least the next 1 to 2 years, and non-core divestments will continue. The national AMCs, they will remain they will maintain their policy laws, and the sector will continue to face stricter regulation, which is a positive development in our view.
And then what about the news on this buyout fund on the solar side?
No, we actually didn't hear any story news about it.
Yeah, maybe to add a bit color, what has been the market chatter is the AMCs are going to set out a buyout fund to buy out some of the tail capacity from the industries that are facing overcapacity, such as solar. But this has not been validated. But overall, it seems like the Chinese banks, AMCs, will continue to do the heavy lifting of national services and to cap some of the bad quality asset in the system, and perhaps supporting growth at the same time.
Appreciate the insights, guys. Kind of flipping around to more situational credits, there's news on the short seller reports and allegations of Vedanta. We have a lot of clients here in Singapore interested in that. Laksh, any commentary for us on Vedanta?
Yeah, Vedanta faced a short seller report from an investigative firm called Viceroy Research. This was in the first or second week of July. Some of the allegations that they cast were revolved around the company's complex holdco-opco structure that made it unsustainable for the main cash generation from the operating company, which includes Vedanta Limited. The other one was irreconcilable interest expenses. Another was on the complex organizational structure and the governance risk, regulatory risk, and so on. We think that out of these main allegations, many of them are actually not that unfamiliar to the market and even to us. For those who have been covering Vedanta, these allegations are not new. They're quite familiar with them, and they have quite grown with the company and having covered, and they've grown to get comfortable with some of these known risks. So we are not very alarmed. Even in other cases, like in the case of these interest expense, we think that could be attributed to the private credit loan, which came at a very steep interest. When it comes to some of the weak operating companies, such as Electro Steel or the Talwandi Sabo plant, again, we think that that's something that we and even the market has considered, and they have they know that these companies are not performing as well as some of the cash generative assets like Hindustan Zinc or the Kane India oil business or the aluminum unit. So in a nutshell, we think that the allegations that were cast were not that material to the credit because of their nature, that they were quite familiar and they were baked into the credit for a long time by investors, and also because the allegations were not that damning and that serious in nature. So therefore, the overall impact, we think, is quite benign for the credit. Just today, we also did another follow-up note based on kind of a few more of allegations that were cast by Viceroy Research over the course of about one to 2 weeks. One of them being that the brand fee paid by the operating company to Vedanta Resources was called into question, and the Enforcement Directorate actually ordered them to refund some of that brand fees in FY24. That was almost 1 year back. So we think that this is slightly a bit more serious as compared to some of the other follow-up allegations that have been cast. This is, we are concerned because it calls into question the lack of transparency from the group, and also because if the Enforcement Directorate were to kind of limit or totally stop further brand fee payments going forward, it will stem some of the cash that accrues for the holding company Vedanta Resources. So that will limit their deleveraging, their ability to repay their debt. So from that point of view, we think it's slightly more serious. But some of the other follow-up allegations, such as cash leakage from Hindustan Zinc, we think that in the grand scheme of things, those cost is not that material. But it still calls into question the frequent related party transactions and the weak corporate governance at the group. And finally, the third one being related to a sham commodity trading business being run at Semiconductor. We think those is we are not totally convinced by those allegations, and we do not place too much weight on that. So in a nutshell, in terms of recommendation, we still like the credit. It has very little debt refinancing risk. It has a good credit outlook. So we like the credit on a fundamental basis. And in particular, we like its 2029 and 2031 bonds for its high carry and maintain a preference for it.
Okay. Yeah, that's headline news there. And I know it's a little bit further in the past now, but a few weeks back, you spent some time with a lot of Hong Kong investors. What was the interest coming from that market in Southeast Asia? It's not an area they've historically really cared a lot about. So what's changing in that market now from your observations?
So a few things came to the surface from that investor meeting. So one was in terms of their interest towards the key areas that they are looking at mainly revolve around their focus on new issue market, trying to diversify away from some of the more traditional and conventional geographical areas of focus. Also, the de-dollarization theme that came up again, where they are trying to diversify or put that incremental income that they get into the fund into non-USD assets. So those were mainly Euro, Australian dollar, Singapore dollar in some cases, and Japanese yen. In terms of the markets that they are looking at, they are cognizant that the Asian credit market is shrinking because, as Zerlina was mentioning, the net new supply is very limited and negative. And therefore, there is that much less bonds to look at in the Asian market. So they're looking beyond the benchmark space, and therefore, their focus is more on regions or the credits from regions such as Australia, Japan, and the Middle East. So when these remain the focus, that's trying to kind of pick up some of the return by looking at off-benchmark, credits and the regions, so to speak. In terms of the others, the picks and pans, of course, remained one of the key interest areas, given South and Southeast Asia offers that much bit of volatile and riskier names. A few high-yield names also in that space, so that provides a little bit of pickup. So the picks and pans remained a favorite topic. And some of the key names that were discussed revolved around like the likes of Vedanta, the Indian renewables, the Adani complex, Genting, Medco Energy, etc. That was of interest. Overall, as we're mentioning, the de-dollarization again is a common theme that came up. With the non-USD assets allocation that we talked about. So I guess these were the main themes that they talked about. Overall, in terms of strategy, so to speak, many investors were preferring the shorter end in terms of duration. The IG was go-to kind of within the credit rating spectrum as compared to high yield, which has rallied. They prefer, like in some cases, picking up some of the high beta stuff where it makes sense and that has still some value left for some additional returns.
Got it. Thanks, Lakshmanan. I'm going to pivot to kind of an interesting question that's come in on the financial side and more correlated to really, I guess, maybe the Singapore-based banks, some speak, that it looks like there's some spread widening between the U.S. SOFR rates and the Singapore SORA rates. So I don't know, Karen, how much you look at those particular rates, but one of the questions just sort of, is the spread widening starting to influence our views on the Asian banks like DBS and any other implications for APAC financials?
Sure. So actually, we analyzed the impact of falling SORA on Singapore banks in earlier note published in June, I think. In that note, we mentioned that our expectation of the impact on net interest margin. So we do notice a faster flow through between the U.S. Fed rate cuts and the decline of the SORA is much faster than before. And unfortunately, it is not returning back to the normal level, which we expected it should. But anyway, the Singapore banks, they did a good job in Q1 despite this fast decline in SORA. They managed to do this by increased CASA ratio and the active reduction in their deposit rates and some hedging strategies. So overall, the net interest margin only declined for a few basis points, except for OCBC, which is larger in decline. But anyway, they did a good job. And for the Q2, the pressure should sustain. So it really depends on how much hedging they are taking. But this one is not open, but we do expect the ability to manage this net interest margin to sustain. So there will definitely be continued pressure on net interest margin, but the decline won't be much surprise to us. But anyway, we expect the Singapore banks to continue to benefit from non-interest income, which should be able to offset the impact on interest income.
Maybe I'll add a little bit background color on this. So if we look at the 5-year OIS swap in SORA versus the 5-year swap in SOFR, which is the US rate, the differential has widened to close to 200 basis points year to date, and this is close to a 5-year wide. One reason being that is because the broad dollar weakness, and SGD has been appreciating. And as everybody knows that SGD is a managed float, and when there is appreciation pressure on the SGD, then there will be additional liquidity in the SGD market because of the regulatory intervention on this, and because of that the SORA rate has collapsed. But if we look at the recent SORA fixing, it has already rebounded from 1.3% that level to close to 1.8%, and so seems like the rate differential between SORA and SOFR is going to probably stabilize around this level without further widening. But this differential is likely going to persist if we are continue seeing the broad dollar weakness against the Asian currencies. Another thing to note is the Singapore government bond yield is also coming down, and the yield differential with U.S. Treasury is also widening. Along with other Asian local currency bonds, Singapore government bond had a very good performance year to date. It's about 60 basis points outperforming U.S. Treasury. And I think the demand for Singapore dollar government bond is probably going to continue, especially for the long end coming from the insurance-related account.
Awesome. I appreciate the continue to send in your questions, everyone, if you have them. One of the names that was headline news for much of July was New World, and I know we partnered up with our lawyer brethren in the CreditSights brand on covenant review. As sort of our house view was an LME exercise. Any updates or things that we should be aware of as we turn the calendar from July to August with New World?
Yeah, sure. This is our favorite credit, always keeping our analysts very busy. So some of the developments in July include the company missed a self-imposed deadline to obtain new money, which is a new loan backed by its crown jewel asset, Victoria Dockside, and led by Deutsche Bank. The reason is being, it seems like it's hard to attract other banks because the banks, they don't want to increase exposure to the company. The negotiation, as similar with a lot of the syndicated loan, it's still ongoing. The second news is the company is looking to sell the 11 Skies, the airport shopping mall asset, potentially to the airport authority at a huge discount, which is about 15 to 20%, to plug the hole of the missing new money from the new Deutsche Bank loan. So it looks like the company is still facing persistent liquidity pressure despite completing a very big loan refinancing package, 86.5 billion Hong Kong dollar end of June. So that's why we think the liability management is going to be a base case scenario. And we think the dollar senior bullets will also be included in the LME because historically the company does not really have differentiated treatment between the senior bullets and the perps. And we see the increased risk of the LME terms might be worse than our expectation given this lack of new money. I think selling the assets, whether it's 11 Skies or some of the Chinese mainland CRE asset in piecemeal manner, will be very difficult given the current market conditions in Hong Kong and mainland China. So without the new money, the LME terms might be worse than our expectation. Of course, bondholders could say no to these terms, but there is always an opportunity cost for holding these bonds and going through the very prolonged LME process. And because of that, our sister company Covenant Review, they did some of the analysis on the amendment terms, on the threshold or the voting threshold for changing the terms under different resolution scenarios. I think it's quite interesting for existing bondholders of newer developments, and given the high chance of this company going through LME management, it will be good to do some preparation ahead of the event.
Appreciate that. Lux, throwing this one to you, and it might be more aimed to our sovereigns analysts, but you've got a lot of familiarity on the ground. And so this question comes in on thoughts on shift of India in terms of sources of oil if Trump does persist with the sanctions on Russia. Like I said, that might be more for our sovereigns team, but wanted to throw out there if you had any thoughts on that question.
So India imports a bulk of its oil requirements. In fact, that contributes to majority of its import bill. It's a key component there. when this Russia-Ukraine war happened and there was sanctions on oil from Russia, India was one of the few that put its hand up and was willing to source the oil from Russia for the discounts that were offered by the oil producers there. So that helped India to, use some of the supplies from there. But they do have, even if that lines get cut, they do have solid supply chain relationship with the Middle Eastern oil producers. So that will be their primary backstop. Given that there is abundant oil supplies there, the relationship between the governments of India as well as some of these Middle Eastern countries is also quite reliable and solid. Other than that, we think that they would also look at sourcing oil from US because with this Trump tariffs and policies, one of the key things that we are seeing is that we believe the US administration is trying to push US energy supplies through these tariffs and to promote and the sale of energy, US energy to different countries in the world. So we have seen that in the trade deal with Indonesia, and I think they would push that even in India for that matter. So that is another source of oil supply for India. Now, of course, that would come at a higher logistical cost, it would come at a higher procurement cost because US energy tends to be more expensive than Middle Eastern oil. So those are the kind of tweaks in oil supply chain that they could go for if this Russian oil gets severed.
Appreciate the insights and thoughts on that.
Maybe taking a step back, and if we look at the broader impact for Asia currencies and credits if there is a reduction of Russian oil supply. I think right now the market is not really looking much at the risk of higher oil prices, even after the Middle East crisis escalation. The spike of oil prices was quite short-lived. But if that happened and that really persists, I think it will be quite negative for the oil importing nations, which is most of the Asian markets, like Max mentioned. India, the other markets quite prominent for oil imports as Philippines, as well as Thailand, Korea being another one, and also Taiwan, all these Asian markets. And if we look at the episode of Middle East crisis, the currencies of Philippine pesos, India rupee, the Korean won, Taiwanese dollar, they all weakened when oil price spiked. If we look at from a credit perspective, in Korea space, even the quasi-sovereigns, a lot of them are dependent on imported oil, and that will result in, on a standalone basis, much weaker credit profile. And for the refinery sectors, as well as the petrochemical related sectors, their raw material costs will be higher, and that will exacerbate their already quite negative credit outlook. I think the other thing to note is why we keep emphasizing it's good to do diversification and into off-index positions into Middle East banks, and some of the Middle East sovereigns like Lux initiated on Saudi Aramco. So I think because of the macro tape will be very volatile, diversification is really key for a lot of the Asia credit investors.
Okay, well, sort of with that last idea on our lips, let me go across the panel and kind of any key picks, pans that you want to leave the audience with as we go into August. I know it's all about idiosyncratic and credit selection now. So maybe starting with Karen, any favorites in the space right now for you?
Well, as I mentioned, we recently initiated coverage on Goron with outperform, but this is just for high yield investors. And we've seen the IG names. We continue to see value in some high carry names, but definitely they are also volatile names. So if you can build the volatility, we still like Vice Horizon. And we actually recently just moved China City Bank AMC, China City AMC back to market perform, but it is also a name that was continue monitoring, because if it's spread pick up against in the guidance again, then it's a good name.
Yeah. Laksh?
In our space, I'll just run through our picks. I won't go into the fundamental rationale in the interest of time. So we like Vedanta's 2931, rather the whole credit. SMC Global Power, PLN's longer end, the 42 to 50 part of the curve. We like PTT PCL, the Thai parent company. We like a few perps in the mix, like Bharati Perp. We like Globe Perp 2026, both perps 2026 callable. Then we like Medcoast 2030 for carry. We do like Indica, but we are trying to rationalize that view, which is a bit more contrarian. In terms of the PANs, we do not like Greenco, very weak fundamental outlook. Renew Power for valuation reasons. Then the PTT Global Chemicals, within the PTT complex, as well as PTT EP for valuation reasons. Freeport Indonesia's 2027 for valuation, and PTT Geothermal Energy. So these are our core topics and trends.
Yeah, I'll do a big advertisement for our insurance analyst Chong. So we have an outperform recommendations on all the Japanese lifers. We're seeing the fundamental being very solid. The relative value is very attractive for investors wondering if there's a negative impact from the surge in JGB yield. I think the short answer is no, because rising Japanese rates is actually good for the insurance solvency because their liability is longer than the asset, and then the decrease in liability will be more than the decrease in their asset. And also a lot of their JGB holdings hold to maturity, so the impact on PLN, the profit and loss and capital is quite limited. So that's our topics. Also coming from our insurance analyst Tron is the Middle East bank coverage, and we still have outperform recommendation in a lot of the UAE banks.
Okay. Well, with that, I think that's a good stopping point here. I want to thank the team for joining us this game. We're going into the dead of summer months now, but hopefully the DCM guys have been listening and they're going to get some supply going and keep our investors happy. But as always, if there's anyone with any follow-on questions, feel free to send them in and reach out to the team. We're happy to engage. And thanks for all for joining us today.